It's because my
Hello,
computer's not.
everybody. This is Albert. Welcome to the Financial Literacy Workshop. We're all so pleased to have you here. We're going to be discussing the housing dream, what you need to know. This is in collaboration with the Alumni Association, with the chapter's College of Business Administration, as well as the Latin Alumni Network, and as well as the Urban and Regional Planning. Well, hello. Once again, my name is Albert Fattal. I am the CBA Alumni Vice President. Professionally, I work at the Board of Governors of the Federal Reserve System. I'd like to now bring Johans to introduce himself.
Hey everyone, my name is Johan Acosta. I'm also part of the CBA Alumni Association as a director. And then on the side, I also work for a financial advisory arm, and I'm a senior associate there. And I'll pass it on to Lupe.
Yes, hi, my name is Lupe Ruiz. I am the president of the Latin Alumni Network. I have over 19 years of experience in the real estate industry, and I am the broker owner of Homefield Real Estate. It's a boutique real estate brokerage in the area. And with that, Manuel.
Hi everyone, my name is Manny Munoz. I am the Urban and Regional Planning President here at Cal Poly Pomona. I am also on the Alumni Association Board of Directors. And my day job, I am the Community Development Director for the City of La Mirada. So I will pass it back to Albert.
Thank you, Manny. It's great to hear all of your accomplishments and professional qualifications. It sounds like we're certainly in good hands and understanding a little bit more about what it takes to get onto a path of home ownership. So let's discuss a bit about what we will be talking about today. At the end of this workshop, you're going to understand economic trends which influence the housing market. We'll then move on to learning the importance of credit and strategies for managing credit effectively, an important topic there. Then we'll move on to gaining the skills in creating a budget, setting and saving goals, and implementing strategies to improve financial stability. Then we'll move on to exploring the different housing types, such as SFRs, ADUs, and townhomes. Then we will move on to discussing the understanding of various types of home loans from key factors like credit history and debt to income ratio and how location influences your choice of home. Finally, we will finish it off with learning about the essentials of home ownership, homeowners insurance, property taxes, and ongoing maintenance costs associated with homeownership. So let's get started. We will kick it off by understanding the setup of macroeconomics, and we'll discuss interest rates and Fed policy. Now, the Federal Reserve's actions, particularly adjusting the federal funds rate, it directly impacts mortgage interest rates. Now, it doesn't exactly dictate what the interest rate is, but it does impact mortgage interest rates. So when the Fed raises rates to combat inflation, this typically happens when there is economic expansion or when the economy is doing really well, then mortgage interest rates will tend to rise. And that's in an attempt to slow down what's considered a hot economy. And that makes homeownership more expensive. Again, that's done to slow down the economy when it's running a little more hot than usual. Now, this tends to raise rates, right? That's making houses more expensive. So, what's the converse of that? That's lowering interest rates. And that will typically happen when there is a slowdown within the economy. Interest rates lowering means home price interest loans will likely lower as well. And that increases the influence of folks going out to get home loans and mortgage rates. Now, potential buyers should also monitor Fed announcements and economic indicators like inflation and unemployment to anticipate interest rate trends. Both inflation and unemployment rates directly influence, from a societal perspective, the realistic capacity of going out to get a home loan. This helps determine if borrowing costs will be favorable to you or not. Let's look at this from a visual perspective. What we see here is a graph of the federal funds effective rate. And if my mouse is transpiring to your screen, hopefully you see my mouse hovering at the year 1980. Each of these gray lines here indicate a recession. And what you'll see is that during recession, interest rates tend to get a little higher and eventually will reduce. So 1980s, the federal funds rate was about 18%. Now, I'm going to go on to the next slide, which is a more applicable graph of what we are discussing today. That's a 30-year fixed mortgage rate. Like you saw earlier in the previous slide, roughly in the 1980s, this may be 1983 right here, the interest rate on a house was up to 17.75. Could you imagine paying almost 18% to finance a house? That's quite bonkers. Fortunately, we see that over time, interest rates for home mortgages, 30-year fixed mortgage rates, did decline. And then most applicably is today, we see that interest rates are hovering anywhere from the 6.5 to 7.5% rate right here. Now, the next macroeconomic understanding is growth and employment. We discussed this earlier, a few slides ago. And a strong economy indicated by rising GDP and low unemployment, it typically leads to increased consumer confidence and spending. And this definitely includes housing demand. This can drive up home prices. Not ideal, but it will happen. However, when economic downturns turn the other way and there's high unemployment rates, less people have jobs, this can decrease house demand, as one can imagine. This potentially lowers the prices to buy houses. Then we'll pick it up by buyers needing to assess their job security and the overall economic health of their region. And I think the key point here is their region, because geographic locality, will oftentimes dictate how job security can go. There are certain areas where, based on its economic infrastructure, it's more susceptible to having longer durations of employment. So when you have a job, I imagine you are likely going to feel more confident. The sentiment will be that you are more likely to go out to get a loan for a house. Committing yourself to a 30-year, probably the most expensive loan you'll ever receive, oftentimes, you probably want job security. So these are some of the primary indicators that one can consider from a macro trend on their foundational movement forward towards purchasing a house. Right here, what we see is housing inventory. This is the median listing prices of homes. And I mentioned in the previous slide that there is also locality that influences the prices, and in this case of homes. What we will see is that throughout time, home prices, specifically in Southern California, continue to move up. And currently, 1,100,000 is roughly the median home price in the general Los Angeles area. That's quite expensive. Now, I've got a question here. So, Andrea, if you can please throw the question to the chat. The question is, during economic declines, home prices may generally decrease. Is this true? Do you think it's false? Maybe it's sometimes. So during economic declines, when the economy isn't doing too well, do you think that home prices will generally decrease? I see the answers are rolling in. I very much appreciate all the folks online here answering this. Great. So now let's go ahead and talk about this. The answer, and this is what transpired in the poll, it is sometimes. This is really going to depend. Typically, one would think when the economy is down, home prices generally go down. There are other factors to home prices, including home starts, new home starts, and again, locality. And California, Southern California, is very special in that locality. Now, this is the final topic in macroeconomics that I will be discussing. That's housing supply and demand, directly correlated to our poll question. One would likely like to learn a little bit about the business cycle and its influence on housing supply and demand. Uh, During expansions, construction will typically increase. The creation of new home based on construction and materials, this increases. That adds supply from a macroeconomic sense. With more supply, uh, prices of homes tend to drop. However, demand is a counteracting measure of that. In a location such as Southern California, the demand is typically far outpacing the supply. So regardless of increasing house supply, the demand continues ticking up, which unfortunately in Southern California often resonates to continued expensive housing prices. So potentially, home buyers should also pay attention to housing inventory, new construction starts, and existing home sales. These are some of the three components that one can consider to get a better idea on when prices can potentially increase in housing and decrease. Southern California is an insulated area, less so applies to Southern California. Now, this is a graph, our final graph here on new home starts. We see that we had a peak of homes being built in the United States, roughly in the 1970s, maybe 1974. And it's been fairly steady. We've had ticks and booms. Again, the gray areas, these are recessions within the U.S. economy. As you can imagine, with the recessions, things slow down, so the build of homes decrease. And then finally, we pick up again following recession, homes increase, and we'll see that lately, over the past 2 decades, home prices have been much lower than they have been historically since the recording in the 1960s. So I'm going to go ahead and pass it along to Johannes.
Okay, awesome. Thanks, Albert. So now I'll start to speak about credit, right? And why is credit important? Well, in terms of purchasing a home, credit is probably one of the best financial goals, and really just building a good credit score overall is just a great goal. Whether it's to purchase a car, purchase a home, or even employers might actually review and look at your credit score as well. So it's a really good key indicator, and really what it does is it looks at your trustworthiness or your ability to make a payment for money that's been borrowed. And it usually ranges between 300 is on the very poor side all the way to 850. Getting to 850 is almost like a game. It's difficult. There's a lot of ways to play the system. Usually, when you're around the 700 plus, you're already in a good credit score range. And some of the key things to get started or looking at a student credit card. So if you're a student, I think like Discover has a student credit card. There are like credit unions that also offer student credit cards. Um, but it's a good way to really get a credit card without any credit history. Another aspect is getting a secured credit card. And really what this is instead of looking at your credit worthiness to determine what your credit limit would be, your secured credit card is the actual cash deposit that you made on the card. So say you open up the card and you put like $5,000 or just 500 bucks into it. Your credit limit would be the cash deposit you limited. So that keeps you from overspending, but it still allows you to build credit. And then the last one is a really clever trick, and that's being an authorized user. This is really key. If you have someone in your family or a friend or someone that you really trust that has a good credit score, they could add you to that credit line. Keep in mind that you get all their good credit and none of their bad credit history. But moving forward, any of their credit payments, so if they miss a payment on that card or if they go over utilization, it'll still affect your score. But it's a really good way to increase one of the key components of your credit score, which is your credit history. So if you're jump on an authorized user, maybe a family member who has a card that's been open for over 20 years, now your average credit score is going to be a lot better than if you just opened a card this year. And you can go to the next slide. I'm not sure who's okay. Yeah, so how is the score calculated? So there's five key factors. The biggest one is payment history. So that's 35% of your score. And the key thing here is that understand that they really just want to make sure that you're making a payment. So if you can't pay the full balance, at least try to make the minimum payment. Um, and more credit history just means more total number of payments. So understand that that also helps you when you open up more credit cards. I'd say obviously don't open up credit cards if you know you're struggling to make your payments on one, but the goal, and you'll see later on, one of the indicators is your credit lines or credit mix. So having different types of loans or credit is important, but the key thing here is that as you increase the number of credit cards, so I personally have like 6 or 7 different credit cards that I use. Of those, I probably only rotate between like 2 or 3. But I keep the other credit lines open because I might use it here and there, make a payment, and now I have a greater total number of payments. And that way, if you do miss a payment, if you miss a payment and you only have 2 credit cards, you could think, well, that's only 24 payments in a year. A missed payment, that's 1 out of 24. Versus if you have 5 credit cards, now you're looking at what is that, 60 payments in a year. So you're reducing how negative a missed payment or just missing a payment or not paying off the full balance would be. Um, the second thing is credit utilization, and I think this is really key. Every credit card has 2 dates that are really important. One is your payment due date, and then the second date is your statement date or your closing date. And credit bureaus, so there's about like 4 different or 3 credit bureaus that will actually get your credit score, and they will only look at your credit utilization on those closing dates. So, for example, if my payment due date is say like April 22nd, but then my closing date is the 28th, they won't calculate my credit utilization until the 28th. So what I usually try to do is I usually try to pay off my minimum payment on my payment due date, and then make sure that I completely paid off my balance before the statement date. And the key goal here again is that you want to be around 10% or lower for your credit utilization. And that basically is just trying to show, hey, if you have this credit limit that is, in the 10,000 to 20,000, you're only using 10% of that limit. So overall, you don't seem as risky as a borrower because you aren't maxing out your credit card, right? And then the third thing, so length of credit history, again, that kind of leans into being an authorized user and why that's important. Um, so as an authorized user, you can increase your credit history. That makes up 15% of your score. And avoid closing out a credit line. So I've had people who they want to close out a credit card because they don't use it anymore. That usually isn't a good idea. As you reduce or close out a line, now your credit mix might be affected. Your length of credit history would also get affected. So maybe use it here and there. Make sure that you use it. Sometimes credit card companies will close a card if there's no activity on it, so be mindful of that. And the goal to get like in that 700 to perfect score range is around an average of 9. Next slide, please. Okay, and then so the last 2 factors, and again, these don't, so if you look, we're already at around 80%, so these make up the remaining 20. So we have credit mix 10%, and new credit or credit, usually people call those also hard inquiries, make the other 10%. So the key thing here is that you should have a mix of credit. So if you're a borrower and you have 6 credit cards, no auto loan, no student loans, no personal loans, no mortgage, they might deduct you in score just because you don't have a mix of credit. So they want to see that in different situations or scenarios that you borrow money for, automobile or for a home or for a credit card, you're able to make the payments. This one's a little tricky, but don't worry because it's only 10% of your score. So to be in the fair range, like that 700, you want around 10 plus accounts, and then to be excellent, it's 21 plus. But again, like it's really a system to get to a perfect score. I think if you're in the 700 range or even 650, you have a decent score. And then new credit. So again, there's a difference between hard inquiries and soft inquiries. Usually, if you check your credit for like an apartment, they might do a soft inquiry, and that basically doesn't actually run your credit through the credit bureau. You also get one free check per year, depending on what credit bureau you utilize. So keep aware that you could always check your actual credit score. Um, but the key thing here is probably just to use like a credit monitoring tool. So like Credit Karma has some, NerdWallet has some, even some of the major banks usually have a credit monitoring tool integrated into their mobile app. But also keep in mind that you will have to, have a hard inquiry whenever you open up a card. If you're pre-approved for a card, usually that won't hit you as a hard inquiry. Sometimes it does. If you have like an Amex or one of those more premium charge cards, usually it's going to be a hard inquiry. But maybe if you get a flyer in the mail and it says you're pre-approved, it might not be a hard inquiry. So you kind of have to like play around and understand which cards will submit a hard inquiry. But usually when you get a loan or a mortgage or a new credit card, you're going to get a ding. But it'll usually fix itself or it'll remove itself from your record after a couple months. So just understand that it's part of the process. You need to build credit. You will need to open loans and credit cards. Um, but overall, it's 10% and your score will eventually go back up. Okay, next slide. I can answer some of these questions too. Um, okay, what is bad about a fair credit score? Nothing. I mean, if you're in like the 600 to 700 range, there's nothing wrong with that. Again, the purpose of this presentation is basically trying to build your credit for home purchase. So you just have to keep in mind that if you're going to take out a loan, you're probably not going to get as competitive as a rate as if you had, a good credit score. So that's the only difference. And a credit score is something that can be it's variable, right? Even my credit score will hop around by maybe like 9 or 10 points, throughout the year. So it's okay. It's a variable score, but the goal is to be in that 700 plus credit score range. Um, how is it that bad credit history does not show an authorized user option? So I think it's just like basically, I'm not really sure why it's like that, but they just take your on-time payments. So they're not going to look at your bad credit score. I would say try to jump on a credit card where you know that they've been making their payments and they maybe, have a good score on that card. But yeah, I'm not sure what the deal is with the credit bureau, but I think really what they're taking is most of your on-time payments and your credit history, and those two key factors are what really improve your score. Um, but they won't take, so if like they missed if they have like a bad credit score or something related to a card because they missed a payment, um, I think that would be included, but it wouldn't affect you because those two factors are payment history and then your credit length. But because you just joined the card whenever you joined it, your payment history, not the bad payments, would be calculated once you become an authorized user. And then for credit utilization, is it better to simply not use your card? No, you want to use it. Um, I would say use it on your fixed expenses, right? Like I use my credit card. So I have a credit card that's I only use for travel. Every time I buy a flight, I use that credit card. Or I have a credit card that's really good for dinners. So understand your points too. And I only use that for dinners. Or I have a credit card that I always use at the grocery, right? So I know what expenses I'm going to have, but I just don't overblow it. Maybe if it's like a big purchase or something, I might just use the debit card if I'm not sure if I can afford it. But yeah, you should definitely use your card. The point is that your credit utilization is always calculated at the statement closing date. So the key thing there is just to try to pay it all off before that closing date. Do your minimum payment on the payment due date and then try to pay it all off on the closing date. Yeah, and these are all good tips. The key thing I would say on plan of action is step 5. So manage your debts and loans. So understand that there's good and bad debt, right? So like student loans, you might be paying like maybe 5%. Maybe if you have a really good loan, maybe 2 or 3%, or maybe 7 or 8 if it's not from if it's not like a supplement or government supported or funded loan. Well, overall, that's a good debt because you're investing in yourself, but perhaps getting like a flashy card that might be a little more expensive than your normal car payment, that might not be the best debt. So always understand that debt is good and bad, but be aware of what is good debt and bad debt. And the key thing is just to always, don't like max out your credit card and don't borrow more than what you can afford. So it's not an infinite money glitch. A credit card should be used wisely, um, and just use the monitoring tools, and you'll be okay. Next slide. Okay, so I think one of the key steps, obviously, is if you want to get a really good loan, which is your mortgage on a home, you should be in that 700 plus range. But before you really want to look at purchasing a home, I think it's also important to create like a living budget. And I say living budget because this should be like a realistic budget. So it should actually be an estimate of what you would be purchasing and expensing on a monthly basis. And I think Lupe will talk about it later, how you can calculate your debt to income ratio and where that applies to, deciding what type of home and the cost you can afford. But always remember that a budget is a permission to spend, not punishment, right? So you're reducing spend in this category so that blank. So I could save to buy a home. So that I can save the 3.5% or 20% to buy a home, or maybe it's so that I can help my parents with, this expense, or that I can travel to Europe. So understand that it's not a punishment, right? You're compromising in one area to improve your budget or your overall funds in another category. So always keep that in mind whenever you're building a budget. Understand your goals, and you'll be um, more capable of actually sticking to it and applying the discipline that's needed. So step one is always to estimate your combined annual income. So if you have a full-time job, this might be like your bonuses, as well as your salary. But if you have like gig work or side work, maybe you have a part-time job or you tutor. You want to combine all those sources of income and then calculate your combined. Um, Always to estimate this conservatively. So if you had, perhaps a job that you got paid bigger on one month than the rest, just do the lower estimate just so you can be more conservative. Understand that this monthly income isn't your gross income, so this isn't after taxes. So after taxes, that'll be your gross income. Then identify your monthly expenses. So once you have that gross income, which is your actual paychecks coming in, look at your monthly expenses. If you have annual expenses, like an annual subscription, just subdivide that by 12 so you get the monthly. Always estimate unknown or unexpected expenses. So like car maintenance, you know, there's ways to just use chat GPT or look online, based on the model, year, and mileage of my car, what's the estimated car maintenance cost per year? Or if you have paperwork, you could estimate that. And then categorize everything, right? So categorize things into like maybe housing expenses. So that could be your utilities, your rent, if you have like insurance or HOA fees. Maybe like your wants and needs also should be subdivided. And that way you kind of create budgets for each of these categories. So maybe like housing is one, fun and leisure is another, maybe like subscriptions, you can categorize those. And it's a really easy way once you have these categories to label each of those expenses and understand what's a want and what's a need. What's something that I need to have and I don't need to have. And that way you can kind of dig through and reduce your expenses. Next slide. Once you've done that, step three is just to compare your total income and these expenses and look at how you're stacking up. So if there's this deficit, where is the overspend? What can be cut out? Maybe, oh, wow, I just realized that I have subscriptions to Netflix, Disney, Hulu, and uh, Peacock. Maybe I could cut out two of those and that'll help me. Or am I spending too much on eating out? What are some alternatives? Um, and the other side is if you have a surplus. So if you have more income coming in than your expenses, where should they go? Should they go into a high yield savings account? Should they be put into an investment account? Maybe if you have a salary, should I increase my 401k or Roth contributions? So it's good to really understand both sides, right? So a budget is variable. You can always increase your income and you can always increase your expenses. So keep that in mind. There's ways to, do gig work or maybe do like dog walking to increase your income, but a key is always try to reduce your expenses. So try to live below your means and find ways to maximize your income. And, that's the best way to do it. And then step four is track spending. So understand that life happens. Your budget might be, hey, I'm saving 50% of my income after everything because I'm living at home, I'm saving a ton of money, and I'm building this big nest to purchase a home. But life happens. Maybe there's a medical expense you have to pay for, or there's a trip that you really want to go, or unexpected. You crash your car, you need a new mode of transportation, you need to purchase a car. So that's why I say build a living budget, something that's realistic. As your goals and life changes, you might need to reevaluate and make some compromises. And use budgeting apps, banking apps. There's a lot of cool apps out there to track, or you could use a personal tracker. I'm kind of old school. My dad made me build the budget when I was in like high school, so I still have an Excel spreadsheet that I use, but I also have personal banking apps. So just keep in mind that whatever works for you, you want to be able to revisit this on a monthly basis. If not monthly, maybe quarterly or every 6 months. But it's a really good way to kind of stay on top of your goals. And it's cool, if you're able to save a good amount of your money, meet your goal, help your parents, travel to Europe, whatever your goal is, purchase a home. Then you feel good that you've been making these compromises, maybe not ordering that steak at dinner, right? Or not going to that festival back to back, maybe going to a concert that's slightly cheaper. So it's a good way to really, build goals and achieve what you want. Next slide. So yeah, how to stick to the budget. This is just a good note. So it's guardrail, not a straight jacket. So treat it as a guardrail, not as like a constricting thing that you have to abide by. If you can automate savings and investing, always do that. It's a super power move. Um, and then use strategies to reduce impulse purchases. So a good strategy is if you wanted to buy something, wait a day. If you still really want to buy it the next day, 10 times out of 10, it's still going to be in that store or on that online store that you saw it on. If you can wait a day and you still really want it, then make the purchase. That's a good tip to really avoid some of those impulse purchases. But be realistic. Maybe one day you're out with a friend and you're like, you want a sweet treat, buy that ice cream. That's okay too. Okay, next slide. Okay, so once you kind of have a good understanding of your credit, you've created this living budget. How do you budget for a home purchase? Well, the first thing you could do is calculate your debt to income ratio. So this is like your expected debts and then your monthly income. From there, you're able to deduce what your expendable income would be. And expendable income is just, on a monthly basis, how much money would you have? Keep in mind that when you purchase a home, a lot of your housing costs are going to be now pushed into your housing costs for, say you're renting, now it's going to be into your ownership, right? So you might be looking at other expenses. So your housing cost should be around 28% or less of your monthly gross income. That's just like, I guess, like a financial advisor. Don't take it with a grain of salt. But that's just a recommendation. But keep in mind when you go from renting, you have, utilities, your rent, maybe renter's insurance. But once you get into home ownership, you have other fees. So you have taxes, you have maybe HOA fees, you might have insurance. You also have to add in expenses for maintenance and upgrades. So when you rent, you don't really have to deal with those or worry about those. And I think Lupe does a good job of explaining how you can calculate those in some of the slides later on. And then in terms of purchasing a home, keep in mind the closing costs and some of the realtor fees. So there might be a need to get the home appraised or do some type of surveying or, just general closing costs. And then if you're working with a realtor, depending on the state, you might have a different split between realtor fees. And then try to save for your down payment. So 20% traditional. If you have an FHA, it could be as low as 3.5. And then always use a mortgage calculator or home, estimate tool to see how much you can actually afford. So I'll put this in the chat. It's from NerdWallet. It's a cool tool. And yeah, now I'll pass it to Manny to go over some of the different housing types.
All right. So here in the state of California, we are in a housing crisis. Part of that is simply because there's not enough housing for the amount of population that we have. And it has been an issue kind of percolating for many decades. Started around the 60s. Traditionally speaking, Southern California has been very single family residence oriented. And because of that, then we haven't had much of multifamily, high rises, and so forth being built to kind of keep up with the demand of population and homeowners. So with that said, I kind of want to go over new different types of pathways to ownership that will allow to get more creative through financing and then just creating that pathway that's best suited for different types of people. So we're looking at single family residence, which is your traditional home, your accessory dwelling units, and Senate Bill 9 units, and the multifamily units. Next slide. So accessory dwelling units, also known as ADUs, is somewhat of a new rule that came out in 2019 by the state of California. It allows for a unit upwards to 1,200 be built on a single family home that can be either converted through a garage, a backyard cottage. It's completely independent, has a bathroom, kitchen, and living quarters. This is definitely an affordable housing option. The ADUs being built from the ground up are definitely a lot more affordable. They range about 200,000 and up when compared to a brand new home. This can also generate retail income, support multi-generational living within the property itself. Some of the benefits to the ADUs are building equity while offsetting the mortgage cost. It is enabled by the state of California, so all cities within the state of California are required to allow accessory dwelling units to be built. In essence, single-family home are no longer as a zoning that limits. You are allowed up to 4 units overall, depending on the size of the lots and so forth. Next slide. So the other type of housing that can happen is called the Senate Bill 9 units, which are commonly called as SB9. This is also a direct new California law that enables homeowners to legally split single family homes. So if you have like a lot, that's, let's say hypothetically, you're doing like 8,000 square feet, you can split it up and have two smaller lots, 4,000. That enables that homeowner to be able to sell off that other lot, build a home on it, or provide ownership to their kids or a family member. In essence, they can build 2 units on each lot, which allow up to again that 4 max, and that can be a primary home, which would be a single family home, and an accessory dwelling unit. So this definitely empowers families to create intergenerational wealth. Um, it's sellable, so it gives that ownership to a newcomer, a new homeowner. It's definitely ideal for the larger lots, corner lots that would help that out. Next slide. Okay. Now the other one is multifamily units. So multifamily units can also be traditionally apartments and so forth. But in this discussion that we're talking about ownership, we're really looking at townhomes. You can also do condos. Condos here are more like in downtown high rises, downtown LA, Long Beach, and so forth. Traditionally speaking, in the suburbs, we have townhomes, which are multifamily homes that share some walls with neighbors. but that have independent entrances and ownership. They basically own the land where the unit is located at. This traditionally has lower maintenance than a detached home. It's traditionally more affordable than a single family home, but it is often part of a homeowner association. So there is that HOA fee tacked on to your traditional mortgage. This is a great kind of starter home with a lower purchase and property taxes that something that's anyone can kind of look into. So I'm gonna answer some of the questions. For SB 9, do you have any structure on it? Or can you buy the land and subdivide? You can definitely buy the land and subdivide. Ultimately speaking, um, I mean, you can find a property that's completely vacant and then you can subdivide it and then you can build the two units on there. You would just have to identify which one would be the primary unit and which one would be the ADU or the secondary unit, depending on what the project scope is. So the second question, does the second home on the same lot require a separate driveway? Not necessarily. For ADUs, the state of California does not require any additional parking for that unit. So therefore, there isn't any driveway associated with it. If you yourself want a driveway leading to it, like in the back, then, to have additional parking, that's completely up to the overall design and the site scope of the home. Okay, and that's it on housing types. So now we'll move on to Lupe.
Yes. Okay. So I wanted to start with a short story, and that's Mary's story. Mary came to me some time ago, and she wasn't sure how she would be able to reach her dream of buying a house. She thought, oh, my credit is bad. I'm in so much debt. I'm not going to be able to do this. She didn't buy right away, but we connected. She was committed to making it work. And so I asked her, how did you do this? She said, I began to save our tax return refunds, putting the money aside. Also began to pay off my credit card debt with the lowest balances first. And once those were paid off, I used that money to pay off the cards with the higher balance. And she was able to buy her first home. She sold that home and then she bought a bigger home a couple of years later. So it at the right time, it doesn't necessarily mean that it's right then and there, but once you you learn more about it, you are able to prepare yourself to be able to reach that goal, whether it's your first home or an investment home. It's possible as long as you follow those steps and learn what are the different options that are available to you. Can you go to the next slide? I have a poll that there's no right or wrong answer with this. I just want to see what you guys think is the biggest financial challenge for the first time home buyer. Okay, I'm seeing all those most is saving for the down payment and understanding hidden costs of home ownership with managing debt to income ratio behind it. Great. Okay, awesome. Thank you for answering that question. Can we go to the next slide? Okay, so what are some of the most common loans, type of loans? There's several, but the most common are FHA, conventional, and VA. The FHA is what a lot of people refer to as the first first time home buyer. They refer to it as that because it's known to require the least amount of down payment, although conventional and also have programs that require less down payment, and VAs is zero. Like you don't, unless you want to, you don't need to. There are different requirements on. This is where we go back to what Johannes was talking about, FICO scores. They do look into account what your FICO score is. There's some as low as 580, but yes, the interest rate is probably going to be higher if your FICO score is lower. There are different types of first-time home buyer loans with an FHA and with a conventional loan. So it's not just FHA, it's just FHA is just known for it. You know, people just refer to it as that. But it's not, there's people who they're not first-time home buyers who have obtained, you know, an FHA loan, depending on the different criteria. The ways that you can explore, also, if you weren't gonna go with a loan, or if you were having difficulty getting approved, you can also get a non-owner occupied cosigner, which is someone trustworthy that will co-sign with you or for the loan. I mean, they're ultimately responsible for that if you were not to pay. So it takes, you know, a lot of you would have to have a close relationship, more likely, or someone who trusts you guys trust each other to be able to do that. There are also low interest private loans. There's also, you could always get a gift for your down payments or for your closing costs. And sometimes there's also seller carryback where the owner finances. And they're, depending on the type of the loan that the owner has, sometimes there's loan assumptions where you do the whole process with the lender, but you keep the terms that they had, and you're able to assume it. And then there's also rent to own. Lately, I haven't seen it that much, but back in, like in 2008 or so, there was a lot of those where you had agreement where you would rent a place and the landlord was willing to eventually, in whatever amount of years you wanted to wait, which could be 3-5 years, whatever the agreement was, you would tell them, okay, yes, I want to move forward with buying this house or not. But, you know, by then you more likely already had an agreement on how much the price was going to be. And then that rent you would be able to use it as part of your down payment. So those are things that I haven't seen that much, but that could happen. If you, you know, you could always ask about that. I'm going to skip this one because I know that Johan's mentioned that one, but we're going to be talking about calculating debt to income. So your debt to income ratio is the percentage of your monthly income that goes toward your monthly debt payment. So this includes any recurring debt such as credit cards, car loans, and student loans. And this is the formula that they're going to use to calculate that debt to income ratio. And typically you want to be, as Johan's mentioned, you know, under 28%. That's what's the recommendation. So we can go to the next slide. And then we're running out of time, so I'm going kind of quick. So types of lenders, same, there's several types, but the most common ones, credit unions, direct lenders, brokers. The difference is the credit unions are member focused. They usually have lower fees, more personalized service, but potentially their approval process is slower. And with direct lenders, they could be the big banks that you know, or they could be the other smaller banks, and they typically are known to make decisions faster, but the products are a little bit more limited that they would if they were a broker, because the brokers work with multiple lenders to find the best rate for you. However, because they are the middleman, they do have their fees, and those might apply, and your closing costs might be a little higher. Next slide, please. So as far as the location, it's important that you take into account the location that you're looking at. There are some cities that, and even in counties, that will offer down payment assistance programs. So, you know, if that's a city that is offering it, and you're, you know, that you're willing, that's that city you're interested in, you can look into that. However, keep in mind that when you apply for those type of loans, they have certain requirements too. And for example, if let's say you apply for one, and it could be that they have a requirement where you will, when you want to sell, the buyer needs to qualify, have certain income that, or not be over certain limits on the income. Or it could be that you need to pay them back a certain portion of the equity. If that works for you, that's fine, but just be aware and ask questions. Sometimes that's the only way, to be able to afford to get that loan and be able to buy that house. The other thing to consider is your roots in the area, your commuting time. Sometimes it might seem like, oh, it's such a beautiful home, it's the right price, this is what I can afford, but then you work so far. And you need to take into consideration that, the commute can kill you, basically, having to drive every day. I know that a lot of people are working from home, but, slowly I'm seeing how people are starting to go back into the office. So take that into consideration. Also take into consideration the safety of the neighborhood. The other thing to take into account is making sure that's not in an area where it's a high risk for fires, because home insurance is getting difficult. It's getting more difficult and more expensive to get homeowners insurance in those type of areas. So take a look at that before you move forward with the location that you're looking into. We can go to the next slide. So what are some of the homeowner essentials? And Johan touched on this briefly, but you need to take into account that although many of the mortgages already include the home insurance and the property taxes in the payment, that is something that's going to be added on to your monthly mortgage payment. So take that into account. Homeowners insurance is going to cover, any liability for injuries or any theft, or, a lot of times some, damages that happen to the house. The property taxes is going to vary, depends on the city, county that you're in. But typically 1 to 1.25%. Plus, if you're in a new development, there might be additional fees for any local bonds, assessments, or improvements. So those are things that you need to take into account. In addition to that, you have the homeowner associations if it happens to be in an area that is a newer development. Take into account also that there might be maintenance costs. Once you become a homeowner, you are the person that is going to have to fix that if something goes wrong on the property. So take that into account. Key areas, roof, air conditioning, plumbing, all those kind of things. One of the things that I typically recommend is for the first year, at least for the first year, have a home warranty on the house. So if something happens, you can call it in and you'll pay a fee for them to go check it out, but it'll cover the expenses that you are probably not ready to afford, because you just recently purchased a home, and most people use most of their money to put into their down payment or their closing costs. So yeah, be prepared for all those unexpected costs. And I would say I just wanted to add one more thing, is on your credit. Johan's explained perfectly what you need to look out for. Just make sure, like, if you get a new credit card, I know that sometimes it's tempting, and you might get excited because you see that you have so much, credit. Just make sure that you don't max it, you don't go above that 30%, because that it ultimately will end up affecting your FICO score. And if your goal is to eventually purchase a home, that's going to affect it. And then I also want to emphasize on what Manny was mentioning about, the multi-generational homes and ADUs. That is a great option if you are not able to purchase on your own. If you can purchase with a family member, together and one lives in one and the other one lives in the other, or if you want to live in one and you want to rent out the other. Those are all options that are available to get closer to be able to reach that goal. And the other thing to keep in mind is that your first home is not always your dream home. Find that first home if you want to buy, if that's what your goal is, and then think about, okay, in the next few years, once my house has enough equity, you could do what Mary did. Once her house had enough equity, it wasn't her dream home, the first home she bought, but she had enough equity and then went on to purchase the one that she really wanted. With that said, I have one more poll, and then if there's any questions, I'll take a look. What is the key factor affecting home loan eligibility? Property taxes, maintenance costs, or credit scores? Okay. All right. So that would be credit scores. Okay, great. Okay, let me see. Let me just be really quick on those questions before I pass it on to Johan. Is there anything that is related to mine? Okay. Okay, that is okay. I think that was for Johannes and Albert. Okay.
Thank
Go
you,
ahead,
Lupe.
Johan.
Much appreciated. Looks like we've got one more poll. This one's from Johans.
Okay, yeah. And I guess this kind of goes into Kevin's question too. So I think Kevin's asking, if you only qualify for Section 8 or you don't have a stable job. So is home ownership right for you? So there's financial considerations. But I guess I want to open up with it's key to really understand that um especially in this economy, and dependent on your state, sometimes renting might be the better financial option. And not just from a financial like expense standpoint, but also from perhaps like getting ahead or saving money or investing. A lot of times when you're looking at purchasing a home, those maintenance, those sunk costs, insurance, property taxes, all those fees add up. Um, and if you're just a renter, you really don't have to deal with that. The landlord or property owner takes on the burden. Work considerations. Is it close to your work? If it's far from work, it might not even be a good option. And then family or friends. Is it a good time to purchase a home? Maybe you're starting a family. That could be a good time. Maybe you do need more room. So understanding if it aligns with your chapter of life. Next slide. I don't want to take too much longer so we can open up for questions. Um, so yeah, going back, like what are my other options, right? So buying a home, I think is like the standard playbook for success. Is that true? No, right? Success is very subjective. If you just rent and you get to travel or pursue your hobbies or live the lifestyle you want to live, then you're successful, even if you don't own a home. So understand that owning a home isn't a key. It is a good investment property at times. If you look at markets like Austin, right, some of those homes have dropped like 30% since 2020. Is that a good investment? Maybe if they bought before the pandemic boom, but it's variable, right? Being an investor in anything, if it's stocks, securities, commodities, or land, it changes. So you might be up, you might be down. But the key thing is success is really just being able to understand what are my life goals, what are my considerations, and then being able to live that in alignment with what you want. And that might be renting or it might be buying. And sometimes, if you save 20%, you have $80,000 saved up to purchase this home. If you put that $80,000 into like a stock or security, or maybe you reinvest it into yourself, is that building wealth? Or maybe your family needed some money, you supported your family. You're not building financial wealth, but you're building relationships and familial wealth. So wealth is also subjective, right? It's not just how much money is in your bank account, your friends, your family, your community, the life you live. That's also wealth, just like your health is. So just other options to think about. I know this is about like how to purchase a home. But purchasing a home isn't always have to be the end goal. There's good ways to build wealth and to stay ahead. And yeah, I think we can go to if there's any other questions. And yeah, here are our
Thank you,
contacts.
Johannes. Yep, thank you, Johannes. Much appreciated. We've got, as Johannes just mentioned here, apologies for talking over you there. As Johannes mentioned, we've got our contact information up on the screen. We welcome you connecting with us. If you have any further questions, we're pleased to answer them right now. Whether you are feeling like turning off or turning on your mic and asking them, certainly it'd be nice to hear your voice. But if not, go ahead and add those to the chat. I know that we've answered plenty of questions throughout this presentation, and in fact, we may have answered all of your questions relevant to the topics that we were discussing here. So give you a couple of moments here to either think of a question or if you'd like to take a screenshot of this, connect with us. If not, looks like we will go ahead and wrap this up. I want to thank my colleagues here from the Alumni Association as well as the individual chapters. We are here really to serve our community, and we're happy to serve our community. We're incredibly fortunate to have you join our meeting today, and ultimately, we wish that you learned as much as we could have possibly taught you around both buying a house and what the best path is for your personal life and trajectory in home ownership. So, with that, I want to thank you all, and I hope you have a terrific and fantastic rest of the day here. Bye bye.
I do have a question.
Oh, sure. Go ahead.
Um, is there an email list for the recording?
I believe they're going to be sending it out. They're going to be sending out to whoever signed up. They're going to be sending out the link.
Yes, you guys should receive it tomorrow morning, the recording.
Thank you.
Thank you all.
Thanks,
Thank you.
Randy.
Good
Any other
night.
questions here?